So, Keisha, you're looking this week at the U.S. Federal Reserve. They said 23 of the biggest banks in the U.S. have survived its severe recession scenario stress test. What does this mean for us?
So typically what happens, this is post 2008, and everybody will remember the global financial crisis and all of these banks having that domino effect where one bank failed, caused another bank to fail, and it rolled right into Main Street where the average person was losing a lot of money. So since then, the US Federal Reserve, which is like the central bank for the US, they have decided that every year we are going to run a stress test where we ensure that banks have enough capital to withstand any negative occurrence that would happen. So they look at 23 of the biggest banks in the country, the top banks, and they create a scenario to say, if interest rates go up, I can give you the specifics of this particular recession. It was if unemployment went up to 10% and there was a 40% decline in commercial real estate, as well as a 38% decline in residential real estate prices, how would banks look? What would happen to their capital? And great news is that all of the US banks passed. Now, the thing is, when banks pass the stress test, they're able to now go ahead and pay dividends. Because what the Federal Reserve wants to ensure is that banks can pay out dividends, but they still have enough capital to withstand any negative scenario that may occur. So banks now in the US, you're going to see them start issuing releases about paying dividends and also possibly doing share buybacks because essentially they have enough capital to withstand any unforeseen event. The thing is, though, the smaller banks, which is where the problem is in the US, the regional banks, their stress test results weren't that favorable because their capital is much smaller. And so if put to that same stress test, they didn't do as well. They still passed, but they weren't as strong as the bigger banks. So a lot of eyes these days are on the regional banks because recall a couple months ago, there was a lot of panic happening, a lot of bankruptcy.
Yeah.
Banks. So that's where the focus is. So yes, the big banks, the JP Morgans, they will always do great. The Wells Fargos of the world, they do great. But it's really the regional banks that pose the risk right now.
So is it all of the banks that have to do the stress test before they can pay out dividends?
Yes, that's the rule coming out of 2008 because banks didn't really, and banks generally, the business is lending out funds. So if you're paying out all funds in loans and there is a severe economic crisis, what happens then to your capital? You may have capital issues, capital adequacy issues, which is very important. So coming out of 2008, the Federal Reserve said, you know what, we're going to do this annual stress test to make sure that our banks are capitalized.
Right. So, but this is just the 23 biggest, but does it say like if any of the other ones? Because the ones that went under, I don't think they were among the 23 biggest, were they?
No, those were all regional banks, much smaller. Right. So they came through okay, but not as great as the big banks. So the thing with the stress test, it's just the scenario that's created by the US Federal Reserve. A different scenario could occur that was never modeled for.
True.
And that could create
like
a different result. So for example, pandemic, nobody would have modeled for a health-related economic crisis because that was the first time ever of this magnitude. So usually the variables that are shocked, unemployment, interest rates, real estate prices, those are the variables that the stress test. It's not usually, all right, let's look from a health perspective and the trickle-on effects, right? Because no one would have anticipated that.
Right. So this is a great indication of what to expect. And this could be your first warning that something is wrong. If there's a bank, for example, that you are invested in.
Well, all the banks pass, so no warning yet. I mean,
no, but I'm saying if there was to be a bank that didn't pass,
then that bank stock price would fall a lot. Mm-hmm. And they would have to also go now to raise more capital because it would mean that the bank doesn't have enough capital to withstand any crisis that would come. So they wouldn't be paying out any dividends. They wouldn't be doing any share buybacks. They would have to now be looking to raise additional capital, whether through a bond or doing additional offering or a rights issue, but they would need to raise additional capital.
I like that this is public. So the stress test is done by the US Federal Reserve and the results are public. So we can be here talking about how the banks all passed them. And if there was a bank that didn't, pass the stress test, we would also know. And you mentioned something, the capital adequacy.
Adequacy ratios, yes.
Right. So StrongLink was asking me why the JSE vexed me. And it was because of that video I did last week about capital adequacy ratios and one of our brokers not meeting the capital adequacy ratio. And, they haven't said who the broker is. So do you think that that's something that we should do here in Jamaica, that we should, make that public, have full transparency and say, have this stress test and then let people know who's doing well and who's not?
So here's the thing, the stress test is a model. It doesn't really represent a real live event. It's a model created by persons within the institutions. They will say, all right, let us create this scenario, which may not occur, right? So stress tests, by their definition, are low probability events. And so releasing names can cause undue panic, because really what a stress test is saying is, if this low probability event that we made up occurs, then the bank would have capital adequacy issues. However, a couple of things. Low probability. We made up the event. It may not occur. So I can see a side of, okay, we don't want to create undue panic around an event that we modeled, we created, versus an actual real life event where think, COVID-19, the pandemic and the impact there to capital for the banks. A lot of banks quickly had to go and secure their capital status. So that naturally happens because the banks should have the different policies and procedures in place so that once crisis hits, they know exactly what their next steps need to be.
Okay, point taken. Yeah. But just to be clear, what happened, what we reported on last week was a real life event in which a broker did not meet that capital adequacy ratio.
Right.
But I'm going to say, I'm also going to throw this in there. It has nothing to do with what you just mentioned. Yeah, we went overboard with the title of the video. The title of the video was "Another Broker Goes Broke," which was unfair of us to say. And I'm going to say this here. I was supposed to do a video saying that, but then I got sick, and so this is my first time, back on camera since all of that happened. So it was unfair of us to say another broker goes broke, because it's not what happened. Broker didn't go broke. But the whole capital adequacy issue is a real and important issue that we should be paying attention to.
Yeah, absolutely, because that's what we need for the financial markets to continue to exist. It is important, but the strength of the stress test is really what drives the report, right? And what goes into the creation of the scenario.
Right. So Leon says, I wonder how our Caribbean banks would perform under a stress test.
Right. Well,
some of our banks are rated internationally, so we have that to look at as well.
Right. So rating agencies, this is what they do. They create stress scenarios and run different institutions through it. So it's all there. There are reports. But again, it points back to the scenario. We have to understand the scenario first. Not to say, well, we do a stress test and this bank failed. Is the scenario realistic? That's the first question to ask. Yeah.
All right, cool. So Philip said, glad you made that clarification. Glad I made the clarification. Preservation of confidence is important. Yeah, people vexed at me last week. Keisha, what I tell you, the amount of phone call that I got last week over that is, all right. And then Roswell says, this is why SSL did what they did, lack of transparency, and people lost their funds. So the transparency issue is one that's, that's what a lot of people have an issue with.